You are doing everything right. You know that, right? Every month, money goes in. You are not spending recklessly. You are not buying things you do not need. You are saving consistently, patiently, doing exactly what every financial article, every parent, every well-meaning uncle told you to do. And yet somehow, and I need you to really sit with this, somehow you are not getting ahead. The number in your account goes up. But something feels wrong. Something feels like you are running on a road that is moving backward. I felt this for years before I understood what was happening. My name is Aleem, and I built this channel because nobody was having this conversation for us, for young Africans on the continent and in the diaspora who are working hard and saving consistently and still wondering why the wealth is not building the way it should. Subscribe right now and give this video a thumbs up. Because today, we are going to name the thing that has been quietly eating your savings. Here is the thing nobody told you. Saving money in Africa is not the same as building wealth in Africa, and the reason for that, the specific mathematical reason, has a name. It is called currency drain, when the rate at which your currency loses value is faster than the rate at which your savings grow. You are not saving money. You are losing it while believing you are growing it. Let me make this real with three people, three real situations. I want you to pick the one that sounds most like you. Emeka is in Lagos. He has been saving 50,000 naira every month for a year. Disciplined, consistent. His balance just crossed 1 million naira for the first time. He sent his mom a screenshot. She was proud. I would have been proud too. That is real discipline. But here is what Emeka does not know. During that same year, while he was saving faithfully, the naira depreciated 25% against the dollar. His million naira? At the start of the year, that was worth approximately $1,200. By the time he hit the million naira milestone, that same million naira is worth approximately $800. He saved for 12 months. His naira balance went up. His actual wealth went down by $400. Not because he spent it, because he saved in the wrong thing. Kamo in Nairobi has been doing the same thing in shillings, 45,000 shillings every month. His savings account pays 7% annual interest, 7% returns. That sounds reasonable, right? That sounds like your money is working. But Kenya's inflation ran at 7.9% last year. He earned 7% and lost 7.9% to inflation. His real return was negative 0.9%. He worked a full year of consistent saving to go slightly backward. And Zara is in London. She earns in pounds. She sends money home to Lagos every month, £200. 2 years ago, that £200 converted to approximately 320,000 naira. Today, that same £200 converts to approximately 260,000 naira. Zara's love did not change. Her discipline did not change. The exchange rate ate 60,000 naira of her effort every month and nobody warned her it was coming. 3 people, 3 countries, 3 currencies. 1 trap. Currency drain does not care where you live. It does not care how disciplined you are. It only cares whether you understand it or not. And once you understand it, you cannot unsee it, which is exactly what I want for you today. There is actually a name for the psychological reason currency drain stays invisible. It is called nominal illusion. And honestly, when I first learned this, I felt a little embarrassed because I had fallen for it completely. Your brain tracks numbers, not value. When your naira balance goes from 900,000 to 1 million, your brain says growth. The number is bigger. The fact that those million naira now buy less than the 900,000 bought 6 months ago is invisible, because the number moved in the right direction. And here is the part that honestly frustrated me the most when I figured it out. The banks know this. They absolutely know this. And they have zero incentive to show you your real return. Because if every bank app showed you your savings account balance alongside its real purchasing power equivalent, you would move your money immediately. So they show you the nominal rate, the number that looks good. They leave the math that matters for you to figure out on your own, which is exactly what we are doing today. Wealthy Africans know about currency drain. They have always known, and they have always protected themselves from it. The wealthy Nigerian family is not keeping their savings in a Naira savings account. The wealthy Kenyan investor is not relying on a shilling money market fund to preserve their wealth. They hold dollar-denominated assets, real estate priced in dollars, foreign currency accounts, not because they are smarter, but because they had access to information and tools that were deliberately designed to be inaccessible to ordinary earners. Until now. The solution is called the hard asset hedge, and I am going to give you 4 specific moves, not theories, not concepts, actual moves you can make this week. I am going to be specific because vague advice changes nothing. You deserve specific, so here it is. Move 1. Dollar-denominated investments. This is the move that wealthy Africans have always made, and it is now sitting in an app on your phone. Bamboo and Chaka in Nigeria let you buy US dollar ETFs from your Nigerian bank account. HISA in Kenya, Easy Equities in South Africa. I personally started with the equivalent of $20 a month when I first understood this. $20. That is not a number that changes your life immediately, but it is the beginning of a portion of your wealth that currency drain cannot reach. Move 2. Inflation-protected government securities. Not all African government instruments are equal. In Nigeria, right now, federal government bonds pay between 14 and 18%. In Kenya, infrastructure bonds pay between 12 and 14%. In Ghana, 2-year Treasury notes pay significantly above the standard 91-day rate. These are not exciting investments. They are boring. That is exactly why they work. Boring investments that outpace inflation are what build quiet African wealth. Move 3. Redirect your group savings. If you are in a Susu in Ghana, an Ajo in Nigeria, a Chama in Kenya, or a Stockvel in South Africa, you are already doing something remarkable. You are already committed to a fixed monthly contribution that you protect, regardless of financial pressure. That discipline is genuinely rare. The upgrade is simple. When your group pot accumulates, instead of distributing it in local currency, redirect it into a dollar-denominated investment for 1 quarter before distribution. Same discipline, better destination. Move 4. The diaspora remittance upgrade. Every month, faithfully, lovingly, money moves from your account to your family's account. And every month, exchange rate movement takes a cut of that love before it arrives. Platforms like Chipper Cash, Lemfi, and Gray are specifically built to reduce that cut. And more importantly, instead of only sending money home as consumption support, consider sending a portion as investment. A dollar-denominated African investment made from the diaspora is an extraordinarily attractive asset when measured in your earning currency. You are not just supporting your family. You are building intergenerational wealth on the continent while you live abroad. And I want to speak directly to those of you watching from the diaspora for a moment. You earn in a strong currency. That is an asset. But most diaspora Africans do not treat it as the asset it is. The depreciation that hurts savers on the continent creates an opportunity for diaspora investors with dollars or pounds. Dollar-denominated African assets are accessible to you at prices that are extraordinarily attractive when measured in your earning currency. You are not just supporting your family. You are building intergenerational wealth on the continent. That is the move that changes everything for diaspora African families. Emeka starts splitting his monthly savings. 40,000 Naira goes into his standard savings account, his emergency buffer, accessible when needed. 10,000 Naira per month converts to dollars through Bamboo. 12 months from now, whatever the Naira does, that portion exists outside the Naira system. Emeka did not stop saving. He just stopped putting everything in one vulnerable place. Kamau redirects 5,000 shillings per month into a Kenya infrastructure bond paying 13% annually. That is it. One move. He found the door that was always there. He just needed someone to point at it. And Zara starts using Lemfi instead of the bank for her monthly transfers. And she opens a Bamboo account, £100 a month into a dollar-denominated African fund. She is investing in Africa from London, building wealth on the continent while supporting her family. Doing what wealthy Africans in the diaspora have always done, currency drain is real. It is structural. It is specifically calibrated for African earners, and it has been running quietly in the background of every African savings account for decades, but it is not a life sentence. Start with 10%, just 10% of your next savings amount. Convert it into something that exists outside the currency system you earn in. That is the beginning of the hard asset hedge. That is the beginning of building wealth that currency drain cannot quietly consume while you are not looking. The wealthy African families figured this out a long time ago. You just figured it out today. If this video showed you something you did not know how to name, if you finally understand why your savings are not building wealth the way they should, smash that like button and subscribe. Share this with one person in your network who needs to hear it today. Because this information should not be exclusive. It should not be locked behind a paycheck size or a country or a passport. It belongs to all of us. I will see you in the next one.